afternoon. Thank you for joining us today for Surge Energy's Q1 quarter, which was absolutely amazing. Surge trades under the ticker symbol SGY on the TSX and ZTPAF on the OTC. With us today are CFO Jared Ducs and Derek Christie, Senior VP of Exploration. There will be a presentation and time for Q&A after the presentation. Please enter your questions in the Q&A box or email me at jessica@adcap.ca. As always, there may be forward-looking statements in the presentation. Welcome, Jared and Derek.
Thanks, Jess.
Thank you.
I'll just put the presentation up on the screen here. Appreciate everybody taking the time to join us today. As Jess alluded to, we'll be walking through our exciting Q1 results here, as well as some of our operational results and assets here with Derek. So with that, I'll just chat up for a few minutes about a couple of the highlights that we're excited about here at Surge from the Q1 release that came out last night. Very pleased to announce one of the biggest outperformances in our company's history as it relates to analyst estimates and production versus our budget. We had anticipated producing this year about 22,500 barrels a day, and we came out well over 1,000 barrels a day ahead of that, producing 23,567 barrels a day on the quarter, dramatically exceeding our internal budget estimates and analyst estimates. And that really helped drive a similar beat on our cash flow, or what we call adjusted funds flow. The analyst community had expected cash flow of about $73 million of funds flow, and we generated over $80 million. So incredible strength coming out of Surge here in Q1 from our perspective, and that's really a testament to our assets here, which Derek will chat about in a few moments. Very active quarter, as Q1 always is in our business. We spent just about $55 million drilling 24 gross wells. And again, as you've heard before, entirely focused on our Sparky in Southeast Saskatchewan, two of the top four plays really in North America. And we're seeing the benefit of that increased focus year after year on the Sparky in Southeast Saskatchewan. In just one quarter, from Q4 of last year to obviously this Q1, our operating netbacks, or our profit per barrel at the wellhead, if you will, we're up over 10% to $43 a barrel here in Q1. So seeing the power of our core starting to shine through. And really, if I step back and think about Surge a year ago, Q1 of 24 to this Q1 of 25, you see that even more so. So last year we worked hard to core up in Sparky in Southeast Saskatchewan, some small non-core dispositions, allocating all of our drilling capital into those two plays. And what you see is really in the numbers. Our operating netback is up 28% from Q1 of last year to Q1 of this year, and our adjusted funds flow per barrel is up 37%. And that's really on very similar oil prices. It was within about 5% oil prices in those two periods. So really the profitability per well is increasing significantly here at Surge year over year, and that is a testament to our asset base. And we've been able to do this while reducing debt. So over that same 1 year period I described, net debt's down $50 million. So we're taking the debt down in that year period and increasing our cash flows or adjusted funds flow. So when you combine those two, it really shows very strong low leverage metrics. So our adjusted funds flow, debt to cash flow, if you will, for Q1 was down to 0.77 times debt to cash flow. We have an undrawn $250 million bank line, and the preponderance of our debt isn't due until September of 2029. So good balance sheet, low leverage, and increasing netbacks. So those are all things that we're very excited about here at Surge and that we talked about in our Q1 release. As you know, here at Surge, we're laser focused on high quality conventional oil assets, finding big tanks of oil in the ground, if you will, and turning them over to top technical folks like Derek to go in and increase recovery factors, apply modern technology, and get more oil out of the ground, all with the goal of maximizing free cash flow for ultimate return to our shareholders. That is the Surge business model. From a guidance perspective, obviously the last several months now have been quite volatile, globally, economically, and of course with oil pricing. What I'm pleased to say is Surge's asset base is able to withstand these sorts of volatile times. While we did budget at $70 oil, we still look very strong at, call it the current $60 oil price. So at these levels, with our hedge book, our asset outperformance, And our ability, as we said in the press release, to flex our capital. We can reduce capital now and still make our 22,500 barrel a day exit rate, no problem. And so when we look at all those levers that we have at current pricing for the rest of the year, we can complete our capital program, maintain that production level I described, pay our dividend, do some share buybacks, all funded out of cash flow at today's pricing. So in a really strong position here at current pricing with Surge. And of course, we have that great torque to the potential rise in crude oil prices. And I always mention it here because I'm an accountant. The tax position here at Surge, very strong, $1.3 billion of tax pools. Many of our peers, even in low oil prices, are having to pay $3, $4, $6 a barrel of cash tax. We have about a 4-year tax horizon at 70 oil here, where we can really shelter those cash flows and return them to shareholders very tax efficiently. So I chatted for a minute there about our hedge book, and just spend a second on it here. We were very proactive. We saw oil well into the high 70s for a brief period in early January. We took advantage of that, put on about 55% of our net oil production, hedged that through to October of this year at about $71 average US WTI pricing. So what that means is we've got today about a $30 million asset or gain, if you will, on that hedge book that's really helping protect the capital program, protect the dividend, and allow us to deliver the sorts of results you saw in Q1 moving forward. So we're in really strong shape that way. We are, of course, very aware of the current economic environment, so we'll continue to watch oil prices, as we said in the release, and continue to flex the capital program in response to global crude oil prices into the back half of the year. Continue to look at independent research as we do here at Surge. Continue to screen as having one of the highest free cash flow yields in the peer group on the left. And doing that while delivering a dividend that on Q1 only represented about 16% of our adjusted funds flow. So the dividend is a small component of our cash flow there on Q1 compared to many of our peers. From an inventory perspective, I'll just touch on this briefly before turning it over to Derek. We talked about the economic concerns globally that are affecting oil prices. Folks look at the demand side of that equation. What I think is a little underappreciated is how low supply is, even with some of the OPEC barrels coming on to protect against cheaters, cover for under delivery elsewhere, etc. Really, when we step back, global inventories still remain at some of the lowest observed levels in the last 7-8 years. So low inventory, and so we think as some certainty comes into the market, trade deals are announced, and hopefully we see some economic growth come back in, that oil will be well positioned to increase from here.
So as Jared mentioned, I'm going to spend a bit of time just kind of going through our assets, talk about our 2025 plans, starting on this slide here. So Surge is extremely focused on conventional reservoirs. All shallow depths, well costs around $2 million for each of the types of wells that we drill, that I'll get into a little more detail on. But we really like that. It provides lower capital risk. We do not need to put big expensive fracs into these wells, and it gives us lower declines, and it's much more economic from a well perspective. So very focused on that. Yeah, this slide. So we have, this is really a summary of all of our oil in place as a company and important our drilling locations. So we have 2.7 billion barrels of oil in place that we own on our lands. And that is booked to as a very low cum to date recovery factor. So the amount of oil that has come out of the ground is a low 6.7%. And then in our independent reserve report, that gets booked up to about 9.4%. When I think of reservoirs like this, you're going to see primary recovery factors north to about 20%. And then when you think of water flood, it's going to go all the way up to 30%. So again, we have a large amount of oil in place, 2.7 billion barrels of oil in place, low cum to date recovery factor, and then a low booked recovery factor of 9.4%. And that 9.4% actually equates to our NAV, which you can see in the bottom corner there. On a proved producing basis, that's $5.42 a share. These are all per share numbers. Total proved $9.33, and then $14.39 on a 2P basis. So again, we're trading well below that. So there's a really good value proposition just from the NAV perspective. Also on this slide, we have our drilling locations. So we have more than 900 drilling locations as a company, very focused in our Sparky and Southeast Saskatchewan, which make up about 800 of those 900 drilling locations. Many of those, so that gives us, at our current drilling pace, that gives us about a 12-year drilling inventory. Kind of jumping into the Sparky and Southeast Saskatchewan, we're extremely focused in those two areas, and these are some of the best plays in North America. This is some independent research that was done by Peters & Co. What they did is they ranked all the oil plays in North America on a payout basis. The top plays that rose to the top were the Frobisher in Mississippi and Southeast Saskatchewan, the Mannville Stack, and the Clearwater. So we have dominant positions in two of those top plays, being the Frobisher in the Mississippi and Southeast Sask, and the Mannville Stack. What I'm going to show you through some of the upcoming slides is not only do we have dominant positions in those top plays, but we're actually drilling some of the best wells within those plays. So we're in the best plays and we're drilling the best wells within those plays. Kind of thinking about 2025 in general, we're spending 170 million capital, 60% spent in the Sparky, 40% in Southeast Saskatchewan. We use a couple different well designs in those areas. Being in the Sparky, we're focused on the multilateral drilling. So you can see that's in about 35% of our drill complete capital, and then also single leg frac wells, which make up about 25%. And then in the Frobisher in Southeast Saskatchewan, we're again focused on multilateral drilling stacked multilaterals. So overall of our capital budget this year, 50% of that will be spent on multilaterals, either in Southeast Saskatchewan or in the Mannville Stack in Alberta. A little bit about the Sparky. So this is an area that we've really been active in for the last 15 years. We've really put together an enviable land position. We've been busy in the Sparky and the Mannville well before this recent kind of gold rush to people really gravitating to the Mannville Stack, taking what's happened in the Clearwater and bringing it south. So again, we've been here for a long time and put together a really enviable land position. Why we really liked it at the start was just the amount of vertical well control we had. There's many vertical wells. There's over 20,000 vertical wells. It gave us a great amount of geological data. We were able to come up with a really proprietary integrated reservoir model that's helped to de-risk our past drilling. We've drilled close to 250 horizontal wells in this area. And then really importantly, we have 500 additional drilling locations. So we proved up the model, had some success with that, and then now we have additional running room. This slide really highlights that. So you can see essentially from 2010, we have gone from zero production to over 13,000 barrels a day in this area. Again, 500 drilling locations, and 140 of those are multilateral locations. A large amount of oil in place with that 1.4 billion barrels, and then 34 net wells being drilled. Again, that's 60% of our capital is being spent in the Sparky this year. One of the real keys to our Sparky development has been our large new Hope Valley discovery. Backing up a little bit, we've had some great production outperformance. It's really been across our asset base, both the multilaterals that I'm going to talk about, the single leg wells, and also Southeast Saskatchewan. But a big component has been the outperformance of this Hope Valley discovery. I draw your attention to the graph in the middle there. So what that is the solid green line is our type well. All of the individual dash lines are the individual wells that we've drilled into this play, and then the solid black line is the average of those wells. So lots of lines on there. The ones you want to really look at are the green line and the black line. So what you can see with that is our type well was the green line, and our actual results are the black line, which is about 20 to 25% above our type curve. So that's really helping to have that production outperformance and really driving a lot of our great results. One other thing on this slide I'll just point out is the consistency of those results. So all the dash lines underneath, you can see that they almost overlay the average. So extremely consistent results. And then these are just extremely economic wells as well. So you can see the type curve economics associated with this. These provide a 0.8 to 0.9 year payout. and that's at an IP90 of 155 barrels a day. And you can see our IP90 is closer to 200, 175 barrels a day. So that type curve, we're exceeding that type curve with those really great payouts. Running room here. So right now we have a drilling rig running in this area, and we will continue to have that pretty much for the balance of the year. We have an additional 80 drilling locations. This year, we're going to be drilling 13 or 14 wells out here. So we have about a 6 or 7 year inventory just on what we've already identified here, going at the pace we have, which is a fairly accelerated pace developing Hope Valley. But not to be forgotten is we are drilling quite a few of our single leg frac wells as well. So this is what really got us into the Sparky, was the single leg frac wells, and why we utilize single leg wells compared to the multi legs I was just discussing is in some of these areas, in particular in the Provost area, we have two or three different sands that we would drill the lower sand and then interconnect all of those with fracs. Then we drill that to 8 wells a section, and then it gives us the ability to convert every second well to water flood, which gives us that additional recovery factor going from that 20% to 30%. Again, very strong economics on these wells. You can see that our average payout is 1 year. So again, a top tier 1 location for us. And again, this is taking about 25% of our capital this year. So moving into Southeast Saskatchewan, this is a great complement to our Sparky. This is taking 40% of our capital this year, primarily focused drilling on the Frobisher, which is about 80% of our capital out here. So again, extremely focused in the Frobisher. Again, drilling stacked horizontals. Why we like it out here is just the low cost of drilling. Here we're about 1.5 million to drill and complete a well. These are open hole. We do not need to do any fracking or run any liners at all. So it's extremely conventional, high quality reservoir that gives us those results. And really, this slide really speaks for itself. So what this is all of the wells that have been drilled in Southeast Saskatchewan, targeting the Frobisher over the last, say, 3 years, really essentially since we entered the play. What you have on the bottom axis, the horizontal axis, is all the companies that drilled wells during that time period. And then on the vertical axis is the average IP90 of all of those wells. So you can see, and actually the number of wells that each company drilled is on the bottom of the chart there. So for example, Surge drilled 76 Frobisher wells with an average IP90 of 198 barrels a day. So industry leading by quite a bit, actually. So that's the next closest is about 180 barrels a day. So we have really demonstrated that we have some of the best assets and some of the best depth of inventory. We have that 290 drilling locations. Again, we've got about an 8-year drilling inventory, drilling 31 wells this year. So, what are we doing differently, or why are we getting such great results? Well, one of the main reasons is that we have accumulated such a great land position in one of the best pools in Southeast Saskatchewan, large pool called Steelman. Associated with that, we have multiple stacked horizons. So the inset there is a well log showing the different subunits within the Frobisher. So what we're doing differently is we're actually drilling multiple legs in a stacked horizontal fashion to target all of these different subunits within the Frobisher. So what that does is it gives us greater lateral extent and just more reservoir exposure. So that's really helping to do that. With a well like this, like it's this one in particular is a drill complete equipped tie-in of 1.25 million, and you can just see the payout associated with this. So the first payout is in a half a year, and then the second payout you achieve in 1.5 years. So these are some of the most economic wells in North America. So really going back to that chart that we looked at from the Peters & Co., as I mentioned, we're in the top plays, but both in Hope Valley and then also here, we're drilling the top wells within those plays.
Thanks, Derek. So I think in closing, before we open it up for some questions, Jess, I'd like to say, we're very well covered. We've got 9 or 10 of the top analysts in the oil and gas space here in Canada covering Surge. You can get their research and chat with Jess if you need it. Got some of the highest upside in terms of analyst average targets to consensus price. And we've been really excited. Our Q1 result is really the result of a year plus of focus on our core areas, and is really setting us up to deliver into Q2 and beyond. As we continue to monitor the current price of oil and the global economy, and we continue to flex our capital program in response to that, really with the goal of preserving the dividend and our free cash flow model here in these volatile times. And we're in a strong position to do it with our hedge book and our assets. So I think with that, Jess, I'd turn it over to you for any questions.
Okay, great. Thank you. You obviously had a great beat on production. A couple questions I have around that. First of all, on the Hope Valley wells, I mean, they're coming in 25% above guidance, but the declines don't seem to be that significant on there. Is that better than you expected, Derek?
Yeah, if you just go back to that chart. Yeah, that's actually part of the production outperformance is the decline is slightly less than we had anticipated. And then the IPs are leveling out at a higher rate. So that is helping for that production outperformance, definitely.
Okay,
Yeah,
so
sorry, Jess.
no, I was just going to say, so potentially we could see higher EURs.
Yeah, at this point we aren't actually adjusting our EURs, but we are, from being a little more conservative on the EURs, but adjusting the IPs probably.
Yeah, given this, we created this play really organically from the ground up. We're trying to be conservative, as Derek said, but one data point that I look at is the first good well we put into here has been on 14, 15 months. It's still doing 120 to 140 barrels a day. So you're continuing to see a bit of that shallower decline. So over time, we'll continue to lift that type curve, but we want to be conservative here and make sure that we continue to over deliver.
Okay, and one more question on Hope Valley. You have about 80 to 100 locations, and how many have already been booked into your reserve report?
Yeah, so that's a great question. We're very lightly booked in this area. So as you mentioned, we have 80 of those locations defined by 3D seismic, and then we have some that are outside of that 3D seismic as well. And we only have 22 of those booked on a 2P basis. So very lightly booked in this area.
Okay, and do you think you've perfected your drilling technique here at this point?
Yeah, sure. Perfected is it's a pretty big word for sure. But we are really happy with our drilling results, and we aren't really changing that many things with it anymore. We did quite a bit of trial of different mud systems, really concerned of some clays. So we kind of came up with the mud system that we feel is the best, played around with some hole design and number of legs. So we're actually at the point that we're really happy with our well design, maybe a few tweaks here and there. Now really focused on getting those costs down. You can see that by us drilling pad locations and really going into more of a manufacturing mode. So we're very happy with our well design and continuing with that design going forward.
Okay, and then you drill this one to the south here, second half of 20, like soon, so.
Yeah, so that has not been drilled yet.
Yeah.
We're currently on a pad. We're in the midst of breakup, which is a good point. So this is the first year that we've been able to, just Hope Valley's been able to do that for us, is drill through breakup. Usually we have to shut down because of road bans, but we're drilling a 6-well pad out here. So we're drilling those wells, and we're able to bring in the fluids and everything that we need, but we're able to concurrently complete those wells, meaning that we drill a well and then we bring in the service rig and actually are able to bring that on production. So that's a big win for us during breakup. So long answer to that is that once we finish this breakup pad, which is in the next probably 6 weeks, we're going to move down and be drilling that well down to the south, which is a key step out well for us.
Okay, great. Thank you. I will take one from the audience here. If oil price stays in the $55 to $60 range, will Surge be able to keep the monthly dividend at current level?
Yeah, no, great question. That's one that many have asked us. And so I mentioned a few of these points, but I'll just fly back to guidance there. So really at 55 to 60, that range here for the balance of the year, between our hedging program and our ability to reduce some of the capital while still getting to 22,500, I think the dividend's quite easily funded in that price range for the next 3 quarters coming out. And then we'll continue to look into the 2026 if that price environment persists. We're already seeing rigs being racked, so potential for cost savings, et cetera, that perhaps drive capital numbers lower and allow us even more free cash at those levels. But hedging and asset outperformance from Derek and the team has put us in great stead at those price ranges for the balance of the year without really increasing much debt, if any. You know, and then of course we do have that undrawn $250 million bank line at our disposal as needed.
Now, I personally think we're kind of at a inflection point here on oil. Some would differ. But how are you thinking? Let's say we do have continued volatility. How are you thinking about capital spending going forward? In both scenarios, if we start to see things go higher, do you increase it or do you keep it at flat? And if oil goes lower, where do you see it? How much do you think you could cut your capex without hindering your production and your dividend?
Yeah, so that's something that we talk about. I'm going to say weekly, but I'm actually going to say daily. So, you know, we watch that extremely closely. Right now, we're in the midst of breakup, as I said. So we do have one drilling rig that is running, but we do have a second drilling rig that is planned to start up in the next month or so. So one of the key levers we can pull is actually delay the start of that rig and still execute all of our program. And with the production outperformance that we have, it's really giving us the ability to do that if we choose. Really haven't talked about the magnitude of dollars that we'd be saving, but we really are looking at it'd be a reasonable capital cut to be able to still maintain that same production profile. So I'm watching that extremely closely.
Okay.
You know?
So in today's environment in the oil market, assuming you had $50 million of excess cash and had to choose between a dividend, debt repayment, and buyback, which allocation do you think would create the most shareholder value?
No, it's a great question. So I think, you know, in that lens today, if someone we came up with $50 million more to allocate, you know, from my perspective, I think we're likely to lean that into the share buyback. Derek showed you the net asset values here. You know, obviously on Sproul pricing here, however, our 1P is $9.33 a share, and that just means our existing production plus about 250 or so booked 1P locations of our 900. So a real reasonable ground truth in this market to valuation. You know, we're trading at, call it half of that. So I think the buyback would make a lot of sense. Obviously, we've spent a lot of time strengthening Surge's balance sheet, but we're now at a point where we have no drawn bank debt, no debt to repay in the coming years. So, you know, don't see us putting 50 million on the balance sheet at this point. And the dividend, as I said, it's well funded for the balance of the year today. So I think, you know, that's funded without increasing debt. So I think an incremental 50 million would probably go to share buybacks given these sort of valuations and how strong our balance sheet is.
Okay. Now I might as well get the rest of these dividend questions out of the way. Down to what WTI price are you able to defend the current dividend, even if it means declining production?
Yeah, so there's a lot of variables in that question. I think, you know, it depends on how long it drops. Is it a short V? Is it a very prolonged COVID style situation? I think what I can say is, you know, we can see line of sight to continuing to pay the dividend through the balance of this year, well into the low 50s if it averages down there, because we do have the balance sheet and those capital levers Derek described. So I think, you know, we've got good visibility for everything we know about crude for the next, call it 9 months of this year, with the hedge book, balance sheet, drilling flexibility that we have there to preserve the dividend. Obviously, if you saw, you know, a COVID 2.0 or something like that, you know, all options are on the table at those points. But in a reasonable fact situation of pricing as we see it, we think the dividends well protected at these price levels, or mid 50s or what have you, down through the end of the year.
Okay. And when I'm going to ask on your netbacks, you dramatically improved them. I mean, obviously better performance from your wells, but I'm assuming also some of the dispositions you did help cut your OPEX. And do you have any other properties that are non-core that you would sell?
So you know, the increase in the netback is, you know, some part those small dispositions last year, and then allowing us to take some of that capital and put it into the ground in Sparky and Southeast. So we've seen op costs go from, call it $22 a year ago into the $18 a barrel range now. With the great drilling we're doing in Sparky, for example, our royalty rates have come down even at 71 oil like it was in Q1 into the 17% change range. The term debt we did has dramatically lowered our interest expense per barrel. So we're really seeing different parts of the business all contribute and aggregate to that significantly increased netback, lower costs, lower OPEX, lower royalty rates, higher oil weighting at 89%. As you said, our last disposition in December was Valhalla, a gassy area that wasn't generating much free cash for us. You know, selling something that really increases your oil weighting and your netback. So all those pieces contribute. We do have, as you see on this map, about 2,000 barrels left of some oily minor assets further up north. Great free cash flow assets. So, you know, if something were to come on those, we'd look at it. We're buyers and sellers every day. We're not entrenched here as management. But as of now, we're very happy with the asset base we've got together. Very oily, low decline, and a lot of upside, as Derek talked about.
Yeah, I didn't think there was much left that you hadn't sold that was non-core. Yeah.
That's right.
Okay, and then looking at your IP90 rates, they seem to be even getting better at Steelman. Neither that or you colored differently on the chart on the graph. But
No, they continue to get better, actually. Yeah.
okay, so it wasn't my eyes deceiving me. How are you thinking further about growing the Frobisher trend?
We, as part of our normal course of business, we're always looking for new opportunities, in particular in the Frobisher and Southeast Saskatchewan. So we're continually adding top tier prospects through both strategic farm-ins and some land sale activity. So we see many opportunities down in Southeast Saskatchewan, and we will be testing a couple of those new Frobisher opportunities in the coming year. So really excited about that. But we're always out looking for new top tier drilling locations to add to our inventory.
Is there much out there right now?
I'm actually talking more organic growth when I'm saying
yes,
that.
okay,
So,
just
you know,
adding
from strategic farm and
organically.
land sales. You know, there are a couple packages for sale publicly right now in Southeast Saskatchewan. You know, anything within our core area, we do a thorough analysis of that, be it the Sparky or Southeast Saskatchewan. But it really has to make sense for us. It has to make us a better company. These have to be, it has to come with the quality of locations that we already own. So that bar is pretty high, actually, when we're looking at these acquisitions.
Yeah, because the economics are so good on your wells, it's hard to beat that.
We're in the enviable position of having a 10-year inventory in two of the top plays. So when we look at things, you know, they're measured to a high bar, and if they meet that bar, then we'll act and increase our cash flow and free cash per share for our shareholders. If they don't meet our tests, and we're happy to pass on things.
Okay. Today Bank of America is predicting a protracted battle within OPEC that could drag on for 12 to 18 months, averaging $60 WTI during this time. Assuming they are right, although nobody knows, how will Surge be able to operate in this type of environment?
Yeah, so I think I'd probably just repeat a few things that I've said on a couple of those, but at 60 oil with our improving capital efficiencies, our hedge book gets us through the next 6-9 months, and then with the improving capital efficiencies at 60 oil, if that persists kind of towards that 12 to 18 month range that was mentioned, our ability to further high grade our capital program, defer some of the land acquisition capital, waterflood capital, we can defer those for a couple quarters. You know, that doesn't impact near-term production. Those are investments in our future. So we can moderate the timing on those to be able to be successful in our capital program and dividend in that low $60 oil environment, given our asset base.
Maybe just flip to this Peter slide for a second.
Good point.
Just one thing along those lines I would just add to this is that, again, we are in the top plays, so we're going to be able to weather the storm better than anyone because we have the top plays in North America. So we have the best economics, so we're going to be able to, again, high grade within that and really drill the best of the best.
Yeah, I always think back to the last huge downturn in COVID, and when you looked at where the drilling rigs that were left during COVID were, it was like Clearwater, Southeast
Yeah,
Saskatchewan, and a bit
exactly.
of Sparky. So, you know, these wells, they pay out the quickest. So in theory, they should be some of the last wells cut by anyone in North America. So
Exactly.
one of the benefits we have of this asset base, to Derek's point.
Okay, so that leads pretty well into this question. Would you supplement your hedging program at $60 if it runs out of if you could actually get hedges off at that point
Yeah,
at
I'm
that
not
price? If WTI remains in the 60 at year end and into 2026, does it continue to make economic sense to continue to produce your inventory or slow down on the drilling and not give away your resource at those prices?
Yeah, so on the hedging front, we may start picking away in the low 60s. We typically target 65 and above, given where our capital efficiencies and our funding levels are in terms of capital program and dividend. But yeah, as it starts to come into the low to mid 60s, we'd start to layer in. We take a very methodical approach to hedging and generally layer in. So take some at say 60, 65, some at 65, 70, etc., and build into a very solid weighted average hedge level that helps protect that capital and dividend program. So when invariably the next downturn happens, you're well protected for at least the first 6 to 9 to 12 months of that.
And then on the capital program, you know, around that $60, we still have very economic projects. So we might have a slightly subdued capital program, but for example, a Hope Valley well at $60 pays out in 1 year. So when you have projects that pay out in a year at $60, you're still going to be drilling some of those wells.
Yeah,
Yeah,
you
and you
wouldn't
look
be putting on a growth wedge or anything like that at those sorts of levels. Obviously, with our strong Q1 production, be very easy to put a few more $1 million to work and add a meaningful growth wedge to Surge. But at these price levels, you know, to that question's point, does it make sense to accelerate inventory at these levels? Probably not, but maintain production, given how quick our wells pay out at 60, given the depth of our inventory, you know, some sort of maintenance budget at those levels, maintaining production or thereabouts makes sense.
Yeah, you look at some of like these more expensive plays and their payback goes down dramatically, at these lower prices.
I think that's why you've already seen many, a good handful of US large producers come out and pull capital, because you see some of those plays towards the end of the sheet. And this was done at just about 70 oil. So those, to your point, you might be looking at 4 or 5 years to get your money back, and you might never get your second payout or make any profit. So of course, the economic answer in some of those plays is don't drill that inventory now because you're not making any money. We're in the enviable position that we truly can get payout and make profits at 60 oil with many of our locations.
And we're not back in the shale growth period where there was growth for the sake of growth. It didn't matter if it was economic. And I think now people look at things a lot differently in the US, and and as we've seen from a number of companies that have come out, I mean, I think most of the shale plays are pretty much tapped out for the most part. I don't see any real growth coming out of them. I mean, Permian's getting gassier, as we see continually. But anyway, talk about that for hours. On the single leg fracs that get 3 layers connected to the bottom pay layer, does the water flood sweep all 3 layers or just the bottom layer, or do you put the water flood injector right into the different layer?
Well, that's the whole, by drilling the fracked well, we're actually interconnecting all of those zones. So you're actually getting both production from that, but then also subsequently flooding all of those zones. So they're effectively flooding all of the layers of the Sparky.
Yeah, we've had great success for a number of years with our Sparky water floods. No real conformance issues. Great oil bank. Our reserve engineers have taken wells that might have initially had 120,000 barrels of ultimate recovery booked to that well, meaning it'll get 120,000 barrels over its life. And we've seen 350, 400,000 barrels booked in some of our Sparky floods historically. So we're seeing the results, and our external auditors are booking those where appropriate.
And so what would be the total capital before you get like a percentage change in your recovery factor?
You have the cost of the drill, obviously. And then the additional conversion cost is pretty minimal, actually. It's maybe a couple $100,000 per well. So not quite sure what you're looking for, but it you know, on a full section basis, quickly do the math. Yeah, like just on a conversion basis, it's maybe a couple $100,000 to convert a well.
Yeah, and so then it takes over time, right? But you spend, call it 800 grand on a section, converting 4 of the wells at 200,000 each. And then you'll see, 10% incremental on that section. But that, of course, takes time, right? You
Takes
get a
time.
little bit
Yeah.
more every year. But the more you do of that, the more you lower your corporate decline rate. So then it has knock-on benefits. Our corporate decline rate goes from 25% to perhaps 24 the next year, 23 the year after, as you continually invest in that water flood. So then we have to spend less capital fighting declines in subsequent years, which then means more free cash ultimately for our shareholders in subsequent years. So that's forever the balance in our industry between drilling amazing quick payout wells like we have now and investing in the future through things like water flood that pay dividends for years and decades to come.
Would you consider drilling some Ducs, take advantage of lower drilling costs in a low price environment to bring on when prices rise again?
Yeah, that's not really how we develop our reservoirs for sure. So no.
Yeah, really, because our stuff's open hole, once you drill it, there's really no
You
completion.
kind of have to bring it on.
And
Yeah.
our wells in Southeast Saskatchewan, by the time we say go, they're on production in 2 weeks. So it's very different than the US, where it's an incredible amount of cost to complete in an incredible amount of time. So there is a business logic down there to be halfway done and then go back down hole. We can do everything in a matter of a couple of weeks. Our longest drills at Hope Valley are 20, 25 days at best, or most. So we don't need to do that. Our Ducs are achievable just through the drill bit very quickly.
Yeah, that's more of a US strategy.
Okay. Are you expecting, not that you really have a lot of NGLs or gas, but are you expecting higher NGL and natural gas prices in the second half of 2025 when LNG exports from Canada ramp up?
Yeah, so again, at Surge, we're incredibly focused on oil. We're 90% oil. Pretty much all of the natural gas we produce is associated gas, meaning it's just a byproduct that comes with the oil we're chasing. So we're really 98% of our revenue is therefore oil. But yeah, I think, broadly, we are seeing the forward curve for gas improve in Canada from about $1.90 an MCF AECO today into the threes, well into the $3 an MCF into next winter. And that is, as I understand it, on the basis of the expectation of LNG Canada coming on. I think our challenge at Surge as it relates to gas is this basin is at its core very much a gas basin with an incredible gas resource, and it's so cheap and quick to come on that as soon as you typically see those pops in gas prices, those gas producers respond with volume, and then the price comes off. So that's part of the reason why here at Surge we've been so focused on oil, is there are windows for gas, but they seem to have been brief and quickly filled.
Okay, given the forward oil curve, I guess we kind of already answered this. Would you expect to hedge or not hedge in Q? We kind of already answered that, really. So we won't bother with that. Sorry, Mark. And I think we've kind of covered everything. Let's see if there's if management was offered a 1p NAV price of $9.33 per share, would you recommend the board take the deal?
I think we'd have to look at everything and see what was in the best interests of our shareholders, given where we're trading today. That sort of premium probably be something you took to the board and then in turn to the shareholders to make a decision on. But we really think that's a good marker for Surge's value, and hope that ultimately over time we could deliver something closer to the 2p number. But I think a premium in this market of that level would be likely something the board would bring to the shareholders.
Okay, and let's end with this question. What are the top priorities?
I think top priorities are protecting the dividend without increasing the debt significantly. So being proactive on hedging, doing the most with as few capital dollars as we can. Derek and the team have been tremendous at that. As an example, last year we spent $195 million We're already down to 170 million this year, and you could see a further decrease from there if needed. So, we're already showing a track record of being able to deliver our production on lower capital, and in this market, we think we can do even more of that given our outperformance on production. So I think maintaining the production base, protecting the dividend, protecting the balance sheet, those are really the three main goals we have in this sort of volatile time, and we think we're in good stead as we see it today to do that for the rest of this year.
Okay, I know you guys okay, I've got just two more that might be of interest here. If buying back stock has the most benefit to increasing shareholder value, why not modify your current dividend payout and do more share buybacks?
Yeah, that's a good question. Our dividend is very much a core part of the business model, and yes, the stock price, like everyone else, has come down in this year, so the yield has come up. But the dividend is funded at these levels. It's a core part of the return. When I was answering that question, it was about an incremental 50 million because we think the dividends are a really solid return, a very attractive, appealing return for shareholders. So incremental capital beyond that, that's how I was answering that question as it related to buybacks. But yeah, we'll continue to always look at the return on capital framework and see where the markets are. But for the foreseeable future, that dividend's at a good funded level at these prices. Just hopefully the market sees that and we see the share appreciation and contraction in that yield effectively.
And I'll ask these last two. How are you handling your wastewater? I mean, I don't think you have as much as a lot of others. Injection well or sending it out to be treated?
They would almost be 100% injected into disposal or water floods. So we don't really treat any.
Yeah. It's not like drilling a Duvernay well where you're getting a lot of. Yeah.
So we have disposal wells at each one of our batteries, and then, as I mentioned, a lot of those would be associated with the water flood, so injecting back into the reservoir.
Yeah, big water recycling operation, lowers op costs, provides source water for flood. It's a good circle.
Okay, I think that's probably it because I know you guys have another meeting to get to. If anyone has any further questions or would like a meeting with management, I'd be happy to facilitate. You can reach me at jessica@adcap.ca. Keep up the good work because I want to retire at some point.
Will do. Thanks, Jess. Thanks, everyone.
Okay, thanks. Bye.